You've probably been thinking that you should start investing because you want your money to grow instead of just sitting around. Investing can seem so complicated and loaded with jargon, and it can feel scary risking your hard-earned money. Getting started is the hardest part, so I put together this quick 3-step guide to investing in Canada. You don't need to wait until you have tens of thousands of dollars or until you master every detail of investing in finances. At the end of this video, you'll feel comfortable enough and ready to invest your first $100. So let's start. Step number 1 is to understand the basics of investing. While you don't need to understand everything, there are some very important basics about investing that you need to understand so that you don't get lost. There are also some points specific to investing in Canada that you need to know so you can grow your money faster. Here are the 5 most important points for you to know to start your investment journey. First of all, what is investing? In most simple terms, investing is when you use your money to buy something that grows in value over time with the expectation that it will return a profit. An investment can be anything from stocks, bonds, also real estate, and even art. But in this video, we are going to talk specifically about stocks. When you invest, you usually hold an investment for a longer period. For example, a year, 3 years, or even much longer. Contrast that with speculating, where people usually buy and sell an asset in a very short time. That's also where a lot of things can go wrong. For your long-term financial well-being, make sure that you invest for the long term. The second thing to understand is why invest. Why not just keep your money in a savings account or even worse, in cash? There are 2 things investing can do for you. For one, investing protects your money from inflation. The inflation rate in Canada is currently around 2.7%. As the prices of goods and services increase, the purchasing power of your money goes down. If you have a $100 bill now, in 15 years it will only be worth $74 in real terms. So invest your money to keep up with inflation or even outpace it. And if you're like most people, at some point you'd like to retire, perhaps rather sooner than later. And it's so great to feel like you have some breathing room and not always worry about money. But for all of that to happen, you need to start putting your money to work. Even if you start with $0 in investments today, but invest $1,200 each month at an assumed return rate of 8%, you'd end up with almost $700,000 after 20 years. Keep investing so one day you can stop trading your time for money and have your money generate more money for you instead. The third basic to understand about investing is the relationship between risk and reward. The higher the risk, the higher the potential reward. There are 2 implications here, and hear me out because understanding these can break or make your investment journey. If someone offers you an investment product that offers a super high return, let's just say 20% per year, that's a red flag. The sky-high return is a clear sign that the investment is high risk and that you should be extremely careful. But the other extreme is, I don't want to take any risk, 0. And here, the opposite of the principle, the higher the risk, the higher the return, is also true. The lower the risk, the lower the return. If you put your money in a regular checking account, which is as safe as it can get, you'll be lucky to earn 0.1% in interest. So be aware that in investing, there is always a trade-off between risk and return. But there's a way that you can reduce the risk while still earning a considerable return of, let's say, 7 or 8%, which is to diversify your investments, and we'll get to that a bit later. The fourth basic thing to know about investing is a basic understanding of tax-sheltered accounts. Now, when you invest money into a regular investment account and make a profit, for example, from selling a stock that has appreciated in value or from dividends you earn, you will normally have to pay taxes to the government. Unless you earn your profits or your capital gains in one of these following tax-sheltered accounts. In Canada, we have the RSP, the TFSA, and the FHSA. In short, when you put your money into one of these accounts and buy stocks, bonds, or other investment products within these accounts, your investments can grow tax-free within these accounts. But there is a limit up to which you can invest in these accounts, which are known as contribution limits. We'll talk more about the differences of these accounts in a minute. For now, all you have to remember is this. When you're about to invest, first try and maximize the tax benefits by investing within the RSP, TFSA, or FHSA. The fifth basic to know before you start investing is about money priorities. Just imagine that your friend has a nice $8,000 saved up. He's so fired up about investing and plans to invest the entire $8,000 into the stock market. But the $8,000 is all the money he has. You definitely stop him and tell him that he needs to make sure he has an emergency fund first. Investing has a risk. In the short term, the value of your investments will go up and down and fluctuate. The last thing you want to happen is being faced with some kind of emergency that forces you to sell your investments while they're down. So make sure that you have an emergency fund first so you'll never have to sell your investments at a loss. And also, if you have high interest credit card debt, make sure that you pay that off first. It's not much use to earn an 8% return or so from the stock market while paying 28% in credit card interest. There are a million more things that you could learn about investing, like how to read a financial statement, and you could also spend 5 years learning everything about investing but never get started. Definitely don't do that. Start with the basics and learn as you go. Now that you understand the most important basics to start investing, let's go on to step number 2. Step number 2 is to open a self-directed investment account. Back in our parents' days, the only way to invest in the stock market was through their bank's financial advisors and brokerage firms. These would offer tailored advice to you, but also charge high fees. Nowadays, you don't need to meet anyone in person. Investing is as easy as online shopping. Self-directed or DIY investing is where investors build and manage their own investment portfolios. With self-directed investing, you decide which investments you want to buy and sell, and also when, all completely online. And there are so many investment brokers or investment apps that allow you to do this nowadays. Some of the most popular ones in Canada are Wealthsimple Trade and Questrade. There's also TD Direct Investing, Qtrade Direct Investing, and many more. There are at least 10 online brokers to choose from in Canada, and it's really easy to go down a rabbit hole researching this and getting into analysis paralysis and end up not starting at all. Usually these online brokers are compared based on things like product offering, meaning if they just have basic products like stocks, bonds, ETFs, or also more advanced options like options, IPOs, etc. Also the fees that you have to pay, how user-friendly the platform is, and its customer service and educational resources. So if you ask me which broker is the best, I'd say for one, it depends on your needs. Wealthsimple and Questrade are often named as some of the best online brokers for beginners. Personally, I have Wealthsimple Trade, and recently I also opened an account with Questrade. But to be transparent with you, the one that I used longer is Wealthsimple. I decided to open an account with them because you can start with any amount as little as $1, whereas with Questrade, the minimum is $250. Also, Wealthsimple does not charge any commissions for both buying and selling stocks, whereas Questrade has a trading fee, although it's pretty low. And I really enjoy using Wealthsimple because it's so easy to use and the interface is clean and simple. And because I keep my investment portfolio very simple as well, it doesn't bother me that they don't have more advanced products like options. And I also don't rely on them to learn about investing, so the fact that they don't have a ton of educational resources also doesn't bother me. I'd say don't overthink your choice. You can always switch brokers later on or simply open another brokerage account. But just in case you decide to go with Wealthsimple, you can get a $25 sign-up bonus if you use my referral link in the descriptions down below. By the way, I'm not sponsored by them, but if you decide to open an account with them and fund it, I will also get a small affiliate fee. So because I've been using Wealthsimple the most, I'll continue explaining using their platform. But it will likely be similar with whatever other platform you choose. The following is very important. When you sign up, at some point you will be asked to choose what type of investment account you want to open, a non-registered or a registered account. And as I explained earlier, if you invest money in a non-registered account, you will have to pay taxes on any capital gains you make from those investments. So consider first to open a registered account. One option, as I mentioned, is the TFSA or the tax-free savings account, and this will be a suitable option for most people. Let's say you invest your money in a TFSA. For example, you buy $1,000 worth of stocks there, and after 5 years, they grow to $1,500. When you sell the stocks, you'll make a profit of $500. If you withdraw your money, you don't need to pay any taxes on it. It's a bit different with the RSP though. When you invest in an RSP, you can deduct the amount amount you put into your RSP from your taxable income, resulting in you paying less taxes now. As long as you keep your money within the RSP and invest it there, it can continue to grow tax-free. But here's the difference. When you withdraw later, your withdrawals will be subject to taxes. You defer your taxes. Instead of paying them now, you pay them later. In general, investing in an RSP is suitable for people who expect their income to be lower in the future at time of withdrawal because they will then be in a lower tax bracket and pay lower income taxes. But having an RSP can also be useful if you're planning on buying a home because you can withdraw money from it and not be taxed at the time you withdraw it for your home purchase. And then there's also the FHSA, which is the account you should prioritize if you plan on buying a home, because in an FHSA, your money can also grow tax-free. I'm not going to go into too much detail here. If you want to find out more, you can watch this video up here. In any case, there's no harm in opening both a TFSA and an RSP, especially if you're starting out with very small sums of money. Over time, you will learn more about the differences between these two accounts and where you want to put any money or more money. If you're planning to invest a large amount at once, then I'd recommend you to learn a bit more about the differences between these accounts. So pick an online broker, don't overthink it, and get ready to start investing. Now on to the last step. Step 3 is to invest your first $100 or even $1,000 if you're comfortable with it. At this stage, you might still feel a bit nervous or excited for you optimists out there and wonder if you're missing something. And again, I want to remind you just how important it is to get started as soon as possible, even with an amount as small as $10 or $100. Personally, I find it very difficult to learn when I'm not involved myself. You can read hundreds of recipes, but unless you start cooking, you'll never learn it. And it's certainly true for investing. When you don't have anything invested or don't have any skin in the game, everything you learn and absorb are just bits of information. You seem to understand it but can't fully grasp it.
I think that without owning something over an extended period of time, like a few years, where one has a chance to take responsibility for one's recommendations, where one has to see one's recommendations through all action stages and accumulate scar tissue for the mistakes and pick oneself up off the ground and dust oneself off, one learns a fraction.
When I studied economics and business, I took so many classes on finance, but ironically didn't invest money myself. I just kept postponing it and telling myself it was too complicated, and to be real, back then it was without all these online platforms. So I ended up with a degree and a bunch of theory, but no real experience, and worst of all, no investment growth. But once I opened an investment account and put my first $100 into it, I started becoming more motivated to learn and really understand more about investing. I wanted to invest more so that my money could grow fast and quickly start working for me. So once you start investing, no matter how small the amount, you have skin in the game. You'll automatically want to understand more about investing because you care about what happens with your money. Now, when your account is set up, make the first step and transfer a small amount to it, let's say $50 or $100. And you can do this by connecting your bank account to your investment platform. Choose which investment account you want the money to go into, for example, your TFSA, and then make your first investment. But don't make this mistake. Unless you buy an investment product, your money just sits there in your TFSA. And this is where many people get stuck again in analysis paralysis, researching for months on end and fretting about what investment to make. There are thousands of different stocks that you can buy in Canada alone, so which should you buy? And this is where we'll talk about diversification and risk. When you buy a single stock of a company, you are putting all your eggs into one basket. Depending on the company's financial performance, the price of the stock can fluctuate wildly up and down. Even very promising stocks can go to zero over the years. Like Nortel, a Canadian telecommunications company, which was a big hit in the late 1990s. The stock peaked at over $120 in the year 2000, but then Nortel crumbled with its stock going towards zero and then went bankrupt in 2009. Just imagine if you had all of your life savings in that stock. That's why it's so important to diversify your investment holding. If one stock goes down, you hopefully have a bunch of other stocks that are on the rise that can compensate for that loss. But here we have the same question again. Say you decide to invest in 10 different stocks. Which should you invest in? Expert investors like Warren Buffett have teams whose jobs are just to research and evaluate investment opportunities, something that average investors like you and I just don't have the time for. But luckily, there's something called an ETF, or exchange traded fund, that solves that problem. An ETF is an investment fund. Just imagine it as a large basket that contains individual stocks or bonds. So by buying one ETF, you can buy stocks of hundreds of companies at once. And there are so many different kinds of ETFs, but specifically index funds are great for beginners. So index funds replicate the returns of a market index, for example, the S&P 500. And for this, we will need to do a short detour. This is related to a simple investment strategy that many beginners use. The S&P 500 tracks the stock performance of 500 of the largest companies listed on stock exchanges in the United States. So when you invest into the S&P 500, you take the pain out of selecting individual stocks and instead buy the whole market. And it has been shown that people who invest into the S&P 500 can outperform professional investors who pick individual stocks. And this is the case for most low-fee index funds. So considering I don't have the time or the skills to analyze each individual stock and compare them, I chose to stick with index funds. And personally, I think it's also the best choice for beginners. The S&P 500 is a popular index to buy into, and its average annualized returns from 1957 through December 31st, 2023 was 10.26%. And yes, you can buy into this index in Canada. There are several index funds that mirror the S&P 500, for example, the VFV or the VOO. These are investment tickers, by the way, codes that are used to identify stocks and ETFs. So in your investment app, you simply type in VFV, for example, into the search bar. Then its price and historical performance will appear. If you have enough funds, you can buy full shares. But if you don't have enough funds, the great thing is that you can even buy fractional shares. For example, just half of the share or less. And that's another thing that I like about Wealthsimple, a feature that not all investment apps have. There are also other funds that mirror the S&P 500, but again, it's important not to overthink it too much in the beginning. Whichever index fund you invest in, over the long run, you'll likely be better off than not investing at all and just waiting. Start investing your first $100 or $1,000, and after that, continue to learn and adjust your future investment. Now, after you've successfully made your first investment, you should feel a sense of excitement. At least that's what I felt. Use this momentum to set up a simple investment plan. Decide how much money you will invest every month this year. You can do this manually by transferring the amount to your investment account, or you can also automate it by instructing your investment app to automatically deduct a set amount, for example, $500 or $1,000 each month from your bank account. Personally, I like to do it manually and invest as soon as I have the money, sometimes weekly, sometimes even small amounts daily if I have money. Now, if you ask me what I invest in, I mostly invest into ETFs or index funds. Now, if you want to learn more about how index funds can grow your money faster, then watch this video next.